The current economic expansion is likely to continue for quite some time. The consensus amongst economists is that 2020 is the greatest opportunity for a downturn. But the question is, we don't have data to sort of support that at this point, and when you look at broader issues like credit market conditions, there doesn't seem to be any red flags currently. On the other hand, we are starting to see some signs of business and consumer confidence slowing down a little bit, and it is starting to bring some concerns to the forefront. So there's a host of measures that we economists like to look at for signs of a potential downturn. One of these is a broad measure that is published by the Conference Board, the Leading Economic Index, and it aggregates a number of these leading indicators. Now, this has been a very reliable predictor for at least the last two downturns, and so we would expect to see that activity roll over. If you look at its current trend, you have seen a deceleration in this leading economic index. But again, until it really starts contracting for a number of months, it's not really an alarming sign for us as economists. There are a few measures that I think are a bit outdated, and one of them that could potentially be problematic is the yield curve shape, or the spread between the 3-month T-bill and the 10-year U.S. Treasury. In general, when we see longer-term interest rates fall below short-term interest rates, markets take this as a sign of things slowing down. Now, let's explore why we see this change in the yield curve shape. It's all about expectations. If markets are expecting less economic growth and less inflation, longer-term interest rates should fall in theory. However, in an environment where there's a lot more global financial interdependence, so what happens in Europe is directly affecting interest rates here in the US, that can also change the shape of the yield curve regardless of the economic growth and inflation environment. And that's something that we think is actually influencing the yield curve this time around, and it could potentially send us some false signals. There are a few other metrics, and among these are really the unemployment rate. Now, there's some question marks about whether the unemployment rate is truly reflective of the environment that we have today. And the reason for this is we've seen a large number of individuals, especially after the financial crisis, choose to retire. So we're dealing with a much smaller labor force, and that means that the unemployment rate is a lot more sensitive to both hiring and layoff activity. So it's a measure that historically has worked very well, but I'm questioning whether or not that will be sustained going forward. You know, if we actually see growth continue at this pace beyond July of 2019, this will be the longest uninterrupted stretch of growth since we economists have been recording the data. So we like to say that business cycles don't die of old age, so we're likely to see this growth continue for at least a little while longer.